Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
I want to bring in Frank Spicer right now. He's CEO of Metafied. He joins us from Myrtle Beach, South Carolina. Metafied is a blockchain ratings company. Frank joins us once again from Myrtle Beach. Frank, good to have you with us this afternoon. Before we get to your comments on the Genius Act and everything you guys are doing at Metafied, and perhaps differently now as a result of what's happening in Washington, just tell everybody what Metafied does, because it's, I think, not clear to people who aren't in the space.
Well, thanks to this kind of legislation, now we can be transparent and fully open and say Metafied gamifies a global competition amongst humans and AI to make a sport out of predicting asset price movements. And we do that through our own token. And now that President Trump and the administration have come forward with this legislation, we can get to work, just like a lot of founders that have been waiting to hear this.
What weren't you able to do before this?
So we were able to understand the movement of asset prices and run AI models against the trends and trades that are going on in the market. But now what we're able to do is link it up with what's going on in the real financial markets and add value to allowing people to be accurate and early in predicting these asset price movements.
How do you see the recent U.S. stablecoin legislation shaping the market? Could possibly tighter oversight drive stablecoin issuers offshore?
I actually don't think so. I think this is a great thing for the market, because the requirement of the Clarity Act and now the regulation framework around the Genius Act is that stable tokens now have to be backed 1-to-1. So what I think you're going to see is stable tokens that adopt the U.S. regulations to be the ones that are trusted. And people will see them as a viable on-ramp to link the digital asset world with the traditional finance system.
What is your view on CBDCs? We have President Trump earlier, just minutes ago, saying that he will cement an order banning CBDCs. This seems to be always kind of hand in hand with stablecoins when it comes to conversations or discourse in this space.
Yeah, so what I think the administration is making clear on that is that you're going to have the innovation in the hands of builders and entrepreneurs. And what they're not going to do is turn the currency itself into a surveillance mechanism, which if a CBDC were to become available in some other countries and were adopted, I think people would be a little hesitant to get involved with it, because all that's doing is letting people track your move and turn you off from the financial system whenever you run afoul of saying something somebody doesn't like or take an unfavorable position. What this does is decentralizes the authority a little bit into the hands of builders and investors.
If you're watching on YouTube or Bloomberg Originals right now, you can see the president is about to sign S1582, the Genius Act. He's in the East Room of the White House. He's surrounded by people within the crypto industry, lawmakers who've been supporters of the crypto industry. You heard him call out a few of the people who were there: Brian Armstrong of Coinbase, the Winklevoss twins of Gemini, in addition to Vlad Tenev of Robinhood, David Sachs, the crypto and AI czar, there as well. I want to get back to Frank Spicer, CEO of Metafied. Frank, what legislation would you like to see when it comes to regulating crypto that is not yet law?
Well, right now there's clarity in the Genius Act as to what is a commodity, which is Bitcoin and Ethereum tokens, and the pathway to define yourself as a security. But I'd like to see some more clarity and some more help in determining what's a utility, because a lot of founders are building things with utility that link the two systems together, that carry value, but have a clear utility to them and are not such the case that they're a security. So it would be really great to see that. But I actually anticipate that we'll be able to work with the government to evolve that. And they seem really open to being able to have a conversation now, where before it was a little less clear on how to make that happen.
It's a big day for the crypto crowd today because the entire market cap of this space just hit $4 trillion, which is a big deal. So in light of
It's like
that,
the size of NVIDIA, right?
Yes, exactly. And really, the story got a lot of views. I see it on Twitter. Everyone's really celebrating. Do you think that macro factors like Fed policy, inflation, or rate cuts still affect the risk appetite? Or because of the maturation of this space, do you think they're kind of isolated and, they have their own factors going on?
I think what we all just witnessed was the mainstreaming of crypto. So given what's happened in the markets recently, I think the stable tokens allow an on-ramp to connect people in their everyday lives to be able to use digital assets. They're going to find their way into assets like Bitcoin and other projects that are worth investing in. And I think what you're going to see is you'll start to see the continuation of the Bitcoin asset, especially, become unhinged from inflationary policy, or in some cases run counter to the markets, because the original intent of Bitcoin was to hedge against central bank inflation. And now with a way to on-ramp dollars into the asset in a digital format, like stable tokens like USDC trading into Bitcoin, you're going to see people understanding, well, when they're printing more money, maybe I'm going to move into an asset that hedges inflation like Bitcoin does, because there's a fixed supply and they're never going to make more than 21 million Bitcoin.
But how do you view Bitcoin? Because sometimes it behaves like a risk asset and moves in step with the NASDAQ, but sometimes it's a haven asset and behaves more like gold, and then Bitcoin lives up to its digital gold status. I feel like critics will say that it's still in the melding phase of discovering its role in a portfolio. What is your take on that?
Well, I think you're right in your observation there. Bitcoin has gone through several phases. So the first was it behaved like digital gold because there was a fixed and finite supply of buyers, and they were basically just voting a vote of no confidence in the inflationary aspects of the monetary system. And then what you saw was people investing in the speculative potential of Bitcoin. But now that it's becoming more and more mainstream, I think more and more people can look and say, well, if they're just going to keep printing more money and they're just going to keep sort of devaluing the purchasing power of my money, maybe I'm going to move some into a commodity that holds value and is non-inflationary. So I think we're moving back to the original intent, and it's just a phase shift of Bitcoin behaving like it was originally intended. I think it's going back that way.
Frank, I think it's fair to say there are people listening and watching right now who are not sold that crypto is even a good thing, not just for the United States, but also for their own portfolio. Sell it to them.
Well, first of all, let me say, not all crypto is great crypto. There's a lot of junk projects out there. There's a lot of nonsense floating around. Yeah, and it's one of those things where you shouldn't throw the baby out with the bathwater. If you look like the original Web 1.0 revolution, where there's a bunch of companies that came about that got a lot of hype and hoopla just because they added .com to the end of a dumb idea, right? That's essentially what we're leaving behind right now with crypto, where we're going to move into the potential of the technology to remit money across, various regulations and various economies in a very cheap and efficient manner. You're going to allow people to trace things by ownership through a blockchain. That's all great technology. And now with some clarity around how it's supposed to be used here in the United States, I think we can lead the way and show people that there are actually viable, great projects that follow the rules, and the technology itself is great technology because it allows you to be transparent about who's owned it before and who you're being transferred to. So you can shift compliance, you can make quick work out of chain of custody, and I think today is a real big step forward in getting us to where the potential of the technology is.
We're speaking with Frank Spicer. He's the CEO of Metafied. Frank, correct me if I'm wrong, but Metafied as a company has evolved in the last few years. Can you talk a little bit about that and the way that you've changed as the industry has changed?
Yeah, so we've always had an AI component to the company, and in understanding the movements of asset prices, but we started off as sort of a ratings company to help people understand which was a healthy asset, which was real, and which was, according to my last point, junk. And we wanted to do that to help people. But where we've landed now is there's a lot of movement and back and forth with these asset prices. And there's a real need to predict the movement of these prices through AI systems. We use neural networks to help predict the movement. But there's gaps that could be filled by people. And what we do is we gamify that competition, turn it into a sport of predicting, like the same way that video games have evolved to be a sport. And we help people fill the gaps in the machine predictions. And we found a real momentum right now, and we're moving to market very quickly. We'll be out in September, and people will be able to get into our games and participate in adding signal to the market and get real value for it.
It seems like that's what we see as the crypto landscape really just grows. Companies also learn to adjust. You earlier mentioned that not all crypto is good, and it's true. From where I sit, it seems like Bitcoin is still really the dominant coin when it comes to Wall Street interest. Are you seeing other coins like Ether, Solana, XRP gaining traction as well when it comes to institutional interest?
Well, if you look at Ethereum, the Ethereum token has moved about 40% in the last month up. It's about 20% up for the week. And what that is a signal that the decentralized finance ecosystem, where all the innovation and smart contracts and stuff are happening, those are waking up, coming into the market. And so Ethereum is worth looking into if you're an investor, because it's indicating that people are developing new and innovative ways to interact with blockchains. Solana is a way to accelerate the speed and efficiency of transacting on the Ethereum network, so it's not so expensive. XRP has its own sort of purview of things. It's more institutional in the way that they're approaching things, and I think the jury's still out, so we could see where that goes. But it's a strong project, and it's worth paying attention to. But I think you're going to see applications evolve on top of the tokens themselves, because if you go back to the early days of the internet and people invented TCP/IP, for instance, no one walks up to you and says, "Hey, are you using TCP/IP?" They say, "No. Do you know Facebook? Do you know Google? Do you know Amazon?" So the way that things have evolved to help people's lives be better, be it faster, cheaper, easier, that's the next phase in what this is all going to bring.
Frank Spicer, good to talk to you again. Co-founder and CEO of Metafied, joining us from Myrtle Beach, South Carolina.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
U.S. housing starts rebounded in June on the strength of multifamily building, while weakness in the larger single-family market pointed to some ongoing struggles with bloated inventories and affordability constraints. New residential construction increased 4.6% to an annualized rate of 1.32 million homes last month. It's picking up after an almost 10% slide in May. That's according to government figures that were released earlier today. Our next guest watches all aspects of the housing market. Great to have back with us Katie Hubbard, Executive Vice President of Capital Markets at Walton Global. It's the privately owned asset and real estate investment company. It's got over $4.5 billion of land assets under management and administration, and more than 80,000 acres under management and administration. Walton Global is in retail, industrial, commercial, and more. Katie joins us from Denver this afternoon. Katie, you were last on with us just about a month ago. Is the residential housing market now better, worse, or no different than it was then?
Hey, Tim, thanks so much for having me. I would say the housing market machine is definitely gummed up right now. And it is continuing to flatline, with the increased housing prices going up 60% from 2019 to 2024, and mortgage rates doubling over the same time. It's just affordability is keeping really everybody stuck.
What do you make of mortgage rates going forward? If you have a 10-year yield that has been pretty sticky, we have reached roughly 4.5% again this week, although we are below that level right now. What does it mean for the potential for mortgage rates to eventually go down? A lot of people think it will be the Fed that could help, but if longer term rates stay sticky, then is there a chance that mortgage rates just don't follow on the path lower?
That is really the challenge. And so we obviously are hearing President Trump wanting to send rates down. However, The 30-year fixed rate mortgage sitting right 6.7 right now is tied to the 10-year Treasury more closely than the Fed funds rate, typically sitting 150 to 170 basis points spread. However, when the market perceives the risk for long-term debt to be greater, the spread increases. And so we really need the 10-year Treasury to come down. Right now, if you're looking at technical analysis, it is channelizing. So it is looking to make a move. Hopefully that move is going to be to the downside, bringing rates down. And really, that's going to be the biggest driver, I would say, for how we get the housing market unstuck. Even with the big, beautiful bill that was just passed, we saw home builder sentiment increase slightly because there are some tax incentives that are going to be helping out in housing, but it definitely isn't going to do as much as it would if we could bring the 30-year fix down.
What is your view on the Federal Reserve's role in this gumming up? And the reason I ask is because of a post that the president made to his Truth Social platform earlier today. Here's partly what it said. He said, too late, which is a nickname he uses for Fed Chair Jay Powell, and the Fed are choking out the housing market with their high rate, making it difficult for people, especially the young, to buy a house. He is truly one of my worst appointments. Is the Fed partly gumming up the market?
I mean, like I said, the Fed funds rate doesn't directly impact. It does, work in lockstep with the 30-year fixed rate. So I would say what the positive that we're seeing in housing is that at the state and local level, we are starting to see some reduced regulation to help with affordable housing, changing zoning laws. For example, Governor Newsom just changed the CEQA Act, which was enacted in 1970. So he's saying it's the biggest reform California is going to see in over 50 years, which is going to enable developers to have less red tape, making it easier to develop in urban areas that have less than 20 acres. So not having to go through all of the environmental red tape that they had to, and making it faster and cheaper. Because historically in California, it's really been a rich man's game to develop. And now people that have just written off development there are going to be taking another look. And so hopefully that and things like that at the state and local level are going to be able to help with the affordability, while, President Trump's comments on the Fed, even if we do bring the Fed funds rate down 3%, like he tweeted a few days ago, that means we're probably going to be in a recession at that time. So there's going to be bigger economic waves and impacts that come along with bringing the rate down.
Of the potential headwinds moving forward, and there could be many when it comes to construction and when it comes to just the creation and proliferation of new homes in this country, one question I have is actually around tariffs still, because you have those Section 232 tariffs still very much up in the air in a lot of ways, particularly with a lot of the housing inputs like lumber in particular. Meanwhile, there's still a big question mark around how some of the immigration policies could impact the labor market when it comes to housing construction. How do you weigh those factors when you're thinking about new home starts in the next year?
Yeah, Shonali, what's really interesting is that Walton's home builder clients, which we work with, mostly publicly traded home builders, they are reporting no increase in costs across the board. In fact, in some cases, they're reporting their costs have come down even since the talk of tariffs. So we're definitely looking out for labor because of deportation issues. So places like California, they might be reducing regulations, but they could have labor shortages. So we have not seen the impact of tariffs from our clients. They're not reporting that. And what's interesting is that publicly traded building supply companies are still operating at near 30% gross margins, while home builders peaked at about 27% gross margins in Q2 of 2022, and they've reduced their gross margins 600 basis points. The building supply companies are still operating at that high gross margin. So what we think is going to happen is that there's really going to be a balance and a dance between, yes, the home builders are really eating into their margins to drive home prices down. They're buying down mortgage rates, offering incentives to keep people buying their homes. But they're going to be going back to their suppliers and saying, like, hey, now it's time for you to eat into some of your margins so that we can keep the homes as affordable as possible. So Lennar is actually offering 13.3% incentives across the board to their home buyers. And in places where they dominate, like San Diego, they have 50% market share. They're offering upwards of $100,000 discount on an $800,000 house to to just their strategy right now is pace over price.
So while that's good news to see a very muted impact on tariffs so far for the home builders, one big problem is that some of the tariffs that have been proposed are not enacted. Lumber in particular. Of course, they're not seeing yet the impact of the tariffs. We haven't seen the tariff yet. And so how are you starting to calculate what future tariff rates could look like on the impact of these home builders, given that there's still so much up in the air? Is there a potential for the industry to be shouting louder about this if they think it's going to create an impact, unless they don't think it is?
Well, for lumber specifically, our clients are using lumber futures. So the lumber that they're going to be building with in 6 months is what they're pricing in today. And then also, the president has really discussed how to open up federal lands for milling lumber in the United States and adjusting taxes to make it more incentivized to have lumber from the United States. And we do have the ability. I was just coming from Portland, Oregon today, and that's a hot topic for them as well. So we're hoping, and we don't really think that the lumber tariffs are going to impact the home building industry as much. In addition, our clients are really trying to use new technology and ways to really reduce lumber and use alternative materials to reduce the dependency on that as well.
Hey, Katie, thanks so much for joining us on Bloomberg Businessweek. We got to run. Katie Hubbard, Executive Vice President of Capital Markets at Walton Global. It's the privately owned asset and real estate investment company.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to Washington, D.C. now and bring in Jordan Fabian. He's Bloomberg News White House editor. He's at our Washington, D.C. bureau. Jordan, I want to start with one of the most read stories on the terminal. You wrote it. It's about President Trump authorizing the Justice Department to seek the release of grand jury testimony from the prosecution of Jeffrey Epstein. It comes after the Justice Department and FBI last week, though, said that Epstein did not keep a client list and that no more files related to the case would be made public. Is it fair to call this some sort of about face?
It's certainly an effort to appease his supporters who are angry with his handling of the Epstein case. But I will note that this move falls short of the level of disclosure that his supporters have demanded, including some members of Congress. They want witness testimony, they want client lists, they want FBI interview records, etc. And this would be a more limited slice of those records, referring to the grand jury testimony. On top of that, the Trump administration has to go to a federal court to ask them to unseal those records. Remember that grand jury testimony is usually kept secret. And so this is not maybe going to see the light of day for a while, if ever. And so maybe a way to appease them now, but it certainly falls short of everything his supporters have asked for.
You talk about it. It's not just his supporters. I've seen clips of the vice president, for example, on podcasts calling for the release of the Epstein files ahead of the election. I'm wondering politically where this is going right now, who's getting behind the president and who in the MAGA universe is saying, wait a second, there is more here that we want to see.
You're seeing the Trump's inner circle in the White House and Congress rally around him, but there are significant cracks, including House Speaker Mike Johnson, who's called for more transparency here in a rare moment of dissonance with President Trump. There's also those outside conservative influencers and podcast hosts that helped propel Donald Trump to the presidency last year and were really excited by the prospect of him releasing files about Jeffrey Epstein, but also the MLK assassination, the JFK assassination. And those folks have really been discouraged by his handling of this matter. And so you're seeing this rift widen as Trump kind of holds out on mass disclosure here.
Now, the move that we're discussing now came after the Wall Street Journal published a report alleging that President Trump once sent a suggested birthday letter to Epstein to which the president said the letter was fake. In a social media post, he had threatened to sue the paper, its parent company, and owner Rupert Murdoch. How is the Wall Street Journal report resonating in Washington, Jordan?
It certainly caught a lot of attention, and it clearly rattled the president given his bellicose response to that report. And that's because it, again, drew attention to his past relationship with Jeffrey Epstein. We had this weird situation where you have the president and his supporters last year agitating for the release of the Epstein files, kind of spinning conspiracy theories that a lot of important people were part of his his inner circle and were perhaps participating in illegal activities. Where if the president is on tape and on camera, partying with Jeffrey Epstein at his estate in Mar-a-Lago in the 1990s. And so you had this weird situation, and that Wall Street Journal report kind of put that back in front of people's minds as he struggles through this controversy.
We should note, too, that the paper declined to comment on the president's litigation threat. Hey, I just wanted to, in the last minute or so that we have with you, Jordan, get an update from you on something that was reported yesterday. The president was diagnosed with chronic venous insufficiency after experiencing leg swelling, though physicians said he's in, quote, excellent health. This is coming from the White House on Thursday. How rare was it for the White House press secretary to sort of acknowledge something not great about the president's health, or is this an okay diagnosis? What can you tell us?
The top line is it is unusual for this White House to be that transparent about the president's health. At the same time, this condition, as they described it, is a fairly common condition. It affects 1 in 20 U.S. adults. It's especially common in those over the age of 70. And so, but at the same time, it was interesting because that highlighted, the president's age coming after a campaign where he hammered his predecessor, Joe Biden, over his age and fitness. And so, I think the White House was especially, cognizant that there were photos out there showing bruising on the president's hand, swelling in his ankles. And so at the same time, they're trying to put that story to rest, saying it's not a major health issue, but it does raise attention to the fact that the president is 79 years old, the oldest man ever to be inaugurated, and time's only ticking.
Jordan Fabian, appreciate you taking the time this afternoon, joining us from Washington, D.C. Bloomberg News White House editor Jordan Fabian there. Check out his reporting and the entire White House team's reporting at Bloomberg.com and on the Bloomberg terminal.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
No. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. It is just about 18 minutes to the close of U.S. equity market trading on this Friday, July 18th. Isabel Lee, does it feel like a Friday to you?
It feels like a Friday. This week felt long and weird, but we're almost going to make it.
We are. Well, almost. We got, 18 minutes to go until the close of trading. We got an hour and 20 minutes of the program left. I think we can do it. The S&P 500 down 0.1%, the Dow down 0.4%, the NASDAQ down fractionally.
And we got a slew of earnings this week, really lots to digest. And with us is Jared Cassidy. He's the head of U.S. Bank Equity Strategy and large cap bank analyst at RBC Capital Markets. He joins us from Portland, Maine. So thank you for joining us, Gerard. So first of all, trading revenues held up strongly in the second quarter, especially in equities. How much of this do you think is structural drivers versus cyclical volatility?
Sure. Thank you, Isabel. I would say that trading revenues are always going to be impacted by market conditions. And when there's increased volatility, like we saw especially in April, trading revenues benefit from that. And so even though the big broker-dealers, the big investment banks, Goldman Sachs, JP Morgan, Morgan Stanley, et cetera, are certainly benefiting from the trading environment, it's more, I would say, cyclical than structural. But again, volatility benefits the trading areas for these banks. And when you compare trading revenues to investment banking revenues, they're much, much larger. Now, investment banking revenues, on the other hand, want stable and calm markets, and that helps those revenues, which really impacted them negatively in April and May.
With Goldman and JP Morgan outperforming in capital markets, what do you think they're doing differently that's allowing them to really gain market share across equity trading, advisory, and many more?
It's a combination of factors of, hiring the right people, having the deeper relationships. But it's also both these companies, and Goldman in particular has pointed this out, is that they have a very laser-like strategic focus to be the top investment bank, or I should say the top broker-dealer to their top 150 clients. So Goldman has identified these clients and has steadily improved the penetration in the wallets of those clients. And it's been a focus point. JP Morgan has been doing that as well. And so I think that's part of the reason that you see their market shares improving in this area, is because of this increased focus, plus having the proper or the right talent in the chairs that do the customer facing has been a factor as well.
As these results have had a few days to breathe, and you've looked at the commentary again and again, and you've heard interviews with different executives, how would you characterize the way they've spoken about the economy? And the reason I ask is because we love looking at the banks because they've got a great view on how U.S. customers are doing.
Tim, it's a really good question. In fact, I was asking that question on the earnings calls because, to your point, think about what we just came through. The president announces his tariff policies in April of this year. The market goes into a tailspin. The economists, many of them, raised the probability of recession meaningfully for 2025. But the bank's results in the second quarter were very, very good. The first quarter of this year, according to the FDIC, the industry had, on an annualized basis, record profitability. And since the second quarter results were in general so far better than the first quarter, that record profitability is likely to be maintained. So what gives? I mean, you have all this uncertainty. We see the headlines, but what the driver, I think, is the employment picture remains very healthy. Not only do we have a low unemployment rate, we're still producing anywhere from 130 to 160,000 new jobs every month. And when you look at the JOLTS numbers, the job opening and labor turnover numbers, we still have a shortage of workers. And so as a result, wage growth remains very buoyant and the consumer is in good shape. Now, corporates and commercial customers, they see a little more relief, I would say, versus what they saw in April when the banks reported first quarter results and the Trump tariff news just hit. So it's still cloudy, but it's not as dark as it was in April. So there's a little bit of better confidence now. We'll see if that holds through the end of the year. But it's really kind of interesting because, in April, nobody was expecting the results like we're seeing today with the banks, suggesting the economy is much healthier than people were thinking it was going to be.
Given the year-over-year rebound in capital market revenues, are we at an inflection point when it comes to broader financials exposure, or do you think headwinds like tariffs or elections still warrant some caution?
It's interesting because, trading revenues for some of the banks were at record levels. And so you could argue that, we have to continue to see maybe record levels for this to continue for the industry. And those are always hard to predict. So I wouldn't say you necessarily have to get bearish on the investment banks or the trading businesses. Plus, we still haven't seen the investment banking results come back to, above trend lines when you look at both ECM, DCM, and advisory. Goldman pointed out that the advisory revenues now are above the 5-year trend lines, but ECM, led by IPOs, initial public offerings, they really have not fully recovered yet. And when that happens, that leads to more equity trading, of course, as more IPOs come out. So there's always risks. We don't disagree with that. There's always concerns out there. So I would say that there's still real opportunities to own banks and investment banks to make money in this market relative to the market. The financials in general are inexpensive. And, should the market go into a correction for the higher PE, higher value stocks, the banks should hold up pretty well relative to the market.
Just 20 seconds left, very briefly. Do the big banks have anything to be concerned about when it comes to fintech firms and crypto legislation?
No, the banks are going to embrace it. The banks are going to be part of it. Nothing to, we don't believe any major disruptions coming from fintechs. The banks are going to be in there fighting it out, and I think they're going to do a very good job in competing.
Gerard Cassidy, head of U.S. Bank Equity Strategy and large cap bank analyst at RBC Capital Markets, joining us from beautiful Portland, Maine on this Friday afternoon.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.